Good morning, traders. It is Friday, 8:15 a.m. on December 5th, 2014. This is non-farm payrolls day. Thanks for joining me, and I apologize for the delay. Usually we start 15 minutes ago, but there are some delays I couldn't do anything about this morning. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. Of course, the biggest news today, non-farm payrolls, which pretty much didn't do anything. But before that, German Bundesbank cuts its growth and inflation forecast for 2014 to 2016 period. German Bundesbank's governor, Weidemann, is vocal about his anti-QE position at the ECB. Now remember that the ECB is between a rock and a hard place. The Fed has a much easier, even though it has a dual mandate, it has an easier time dealing with policy issues because it's a united, it's the United States after all. But here with the ECB, you have an issue where stimulus is clearly needed and stimulus is forthcoming. That was the spike yesterday afternoon. But Germany is absolutely against it, against further deflating or reducing the value of the currency and so on and so forth, and just increasing debt. Not against devaluing the currency, but increasing the debt. German October factory orders month on month 2.5% versus 0.5 expected, so much better. Year on year 2.4% versus 0% expected. Again, better news from Germany. Eurozone Q3 preliminary GDP comes in line, 0.2% versus 0.2% Q on Q, and then 0.8 in line year on year. Japan's PM advisor Honda says Japan needs at least a 4 trillion yen stimulus package. 4 trillion yen. If you're trading the U.S. Japanese yen pair, that may be important information for you. He noted that aid for low and middle income earners was needed to revive Abenomics. He also noted that current yen currency weakness was faster than expected, but U.S. dollar yen would not rise above 130 to 135. November unemployment rate for the U.S. came out at 7:30, about 45 minutes ago, 5.8% in line. Average hourly earnings 0.4 versus 0.2 estimated, so better. Year on year 2.1% in line. Average weekly hours 34.6 in line. Change in non-farm payrolls 321,000 versus 230,000 consensus. Note that this is the highest since May of 2010. Highest since May of 2010. Compare that. We're going to compare that with the action we got this morning and see the telling signs that this provides. Change in private payrolls 314,000 versus 225,000. That's quite a beat. Following that, October trade balance came in at negative 43.4 billion versus 41.2 billion estimated, slightly worse. And in Canada's November net change in employment is negative 10.7, expected zero change. Unemployment's at 6.6 in line. Looking ahead, we have 9 o'clock Central. We have October factory orders negative 0.1 is the estimate. Prior is negative 0.6, so it's expected to be slightly better. Again, 30 minutes after the open at 9 Central. Also at 9, there's a possible October durable goods revision change. And then at 11:30 Central, we have Fed's Meister speaks in Washington. At 1:45 Central, Fed's Fisher speaks via video to IMF event in Washington. And then at 2 Central, we have October consumer credit, 16 billion versus 15.9 billion. That's a third tier number. Let's look at the technical picture here. So yesterday, very interesting. Again, I encourage you, for those of you who don't know me very well, It may seem like I'm just here to say I told you so. That's not the purpose. The purpose here is to look at what we had expected and why, which is what these trader bites are for, before the market opens, and then compare it to what we have. Yesterday's primary trade idea is a test of 2072. 2072 is that old point of control, naked point of control, naked VPOC, and it's the highest volume node. It was the highest volume node before new highs. We predicted new highs on Tuesday, and we got on Wednesday, and we got those. And then yesterday, the expectation was for a test of 2072 early on. I'd said 2072.25 is the over underline, and it's exactly what we got. We opened right at the point of control of prior day at 69.75, pushed right to 72 on the dot, rotated down and broke lower. I had indicated that given the way the market was opening, my primary hypothesis that I did the night before had changed and it was looking lower. So the expectation was for an early test up and then sellers to come in, and they did. Targets below at 65. And then again, 60.75 was the next high volume node below. 60.75, it got to 61.25. So the primary hypo worked beautifully. Now, what came next was completely unpredictable as far as I'm concerned, unless I had an inside line into the ECB. Remember, yesterday was the ECB announcement and conference. And what ensued once we got to that lower target or missed the lower target by 2 ticks, balance. And then the idea here is that we had an impulsive move, a continuation move on a higher time frame. We still had an impulsive move, and the expectation is for a pullback to the mid area, 66, 67. Remember, 67 is key in this area, and then a potential rotation lower into into this 59 support area. And what came actually was a train track, just a freight train run all the way to new highs on the ECB's announcement that there would potentially be QE at the beginning of next year. So the market ran up, and it indicated on Twitter, be careful, this run up had no counter rotations, did not have a single 6-tick pullback, and as such, it is not a complete auction. Look out for the scene of the crime. The scene of the crime is right here, 65, the 65 area, and guess what? The market rested for a bit, and then it finally came back to where this move started from. The trade was a lot more methodical in the ES than it was in the NASDAQ. The NASDAQ was a little tougher to read. The run in the NASDAQ was 35 points, and then it took quite some time for it to come back, and it didn't quite balance at the low. The scene of the crime wasn't as obvious in the NASDAQ as it was in the ES in this instance, although the NASDAQ generally has better structure in my opinion. So overall, the market traded and auctioned as expected yesterday, except for this impulsive move up. News moves are impulsive in nature, but they don't behave normally. They don't behave like self-generated impulsive moves where you get a pullback and a continuation. So here you could see it ran right through the mid, back down to the 65, and then pushed up into the close. And this comes right before non-farm payrolls, makes it very difficult to predict what the likely move is next. Again, I emphasize likely, probable, not what the market should, will, must, has to, or needs to. Always keep your mind open to whatever the market's generating. Overnight, we opened right where we closed as expected, pushed up to 2075, sat sideways pretty much the entire session. It opened right at 2072, and from there we have the non-farm payrolls basically pushing the range 2077. Sorry, 2077 down to 2068.50, and what we see here is a blowout number. Remember, non-farm payrolls came in at 321 versus 230, again highest since May of 2010. Yet we were unable to break yesterday's high, which was 2077 quarter. We missed it by a tick, and the low is in line with yesterday's range. For this reason and this reason alone, I believe that we need to be careful this morning, not to anticipate breakouts or anything. I think the market seems to show some signs of just fatigue. So this morning, opening in range, in value, right above the point of control, right in the 2072 area. We have 2067 magnet below us. I think the morning is going to be very choppy. I think the trade is going to dry up very, very quickly. So this is a good day to kind of pick your spots. Only trade when you see a clear edge. We never know what's going to happen next, but it makes no sense to get yourself caught up early on in the flip back and forth as larger participants adjust and hedge their underlying positions. Let the market settle for the first 15 minutes or so, and then and we have factory orders, but that's a second tier number, and then I expect that it would probably stay in range of yesterday's trading for today. I'm out of time. I'll leave you with that. Again, please, it is Friday. Do not get aggressive. Be aware of your emotions. Do not let your gut or your emotions or your need to be right or your need to make your money back get in the way of being a trader. Do not trade like a gambler. Fridays are very notorious in my experience for bringing that out in people, and it leaves you feeling very empty at the end of the day as you approach your weekend with a hole in your pocket. It kind of ruins 3 days with action that might take 15 minutes of you getting flipped around and getting emotionally involved or chasing your P&L. It's been years since I've been advising people and my own traders to not put their P&L on their screen. You're not trading your P&L, you're trading the market. So you're generally aware of how you're doing, and just pay attention to what the market's doing, what opportunities it's offering you. After all, you're a trader. You can only trade the probability of on the hard right edge, and that's what you need to focus on. Your P&L does not help you make smart decisions. It just brings out the emotions in us. So just tuck that away and focus on what the market story is. The context is key. So focus on the story. If you cannot read the story, do not trade. Good luck.